The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to CW's webinar. I'm Carolina, and me and my team are here to bring you the main highlights of one of the most recent sections of Volume Forecast Report, VFR. And this first half 2020 update, we present the long-term forecast for cement demand in the next 30 years. On today's agenda, we will start with a bit of an introduction on our company, what it is that we do, and what we have to offer, presenting a summary of our products and multiple advisory and research efforts. After that, I will share some information about today's presenters and a bit of our background. I will soon after that provide our perspective on the current macroeconomic scenario to then move and provide a snapshot of cement demand across the world this year. Basically, a bit of a takeaway points of on one of our last webinars on VFR as well, the main one. And we will, of course, then end with a main highlight of our long-term forecast for cement demand until 2050. For today's presentation, I would like to introduce Prashant Singh, Associate Director at CW Group. He's based in Mumbai, India. And I will also take this opportunity to present myself, Carolina Pereira, Advisory and Research Manager at CW Group, based in our European office in Porto, Portugal. You can find in this page our contact details, and I encourage you to reach out in case you have any questions. For the familiar names that I now see in our attendees list, I ask you to bear with me for a couple of minutes while I do a brief introduction for those who don't know our company. CW is present across three distinct verticals: advisory, research, and media. Under advisory, CW works with major global consultancies and leading institutions, including the World Bank and sovereign wealth funds on projects. We provide consulting and advisory expertise on a diverse product portfolio. We have helped multiple industry participants on their decision-making process. This includes projects like feasibility studies in the Horn of Africa, market assessments in South America, and market entry strategies in the Middle East. This, of course, is a very, uh, different times, require different measures, and we have kept a very active role on helping these institutions and their strategy persons and decision makers exactly making their decisions the more informed and best way possible. Under research, CW focuses on producing syndicated reports. These reports cover areas like cements, building materials, coal, petcoke, bulk shipping, and also paper and pulp. Although we are well known for our studies on cement demand globally, as well as detailed industry and country reports, we provide forecasts, and of course historical data for markets in a variety of products. One of our best sellers and the product that we are most known for would be this one, VFR, Volume Forecast Report, but also Trade Prices Report that we update on a quarterly basis, as well as white cement reports, fee-based trade reports, and of cementitious products, and of course much more. We also provide commodity price assessments for cement and clinker on a monthly basis. Now, and to finish the company presentation under the media umbrella, you can have access to our online database. We provide newsletters focused on cement, building materials, coal, pet coke, bulk shipping, in the industry of paper and pulp, with latest industry news selected by the research team. So in terms of content-wise, this keeps us very up to date what's new in the industry. We also hold industry-specific meetings. Those are called CW Summits. After the success of the Americas edition in January, held in Miami, and where I had actually the pleasure of participating, we are now preparing a Europe, North America, and Middle East edition in Madrid, but of course later on the year. Please contact us in case this is something that you would be interested in participating. You can, of course, also find us here hosting multiple webinars every month. We use this platform to share the latest findings from our research work and quite a bit of our thoughts and opinions on the market. I would take the opportunity to invite you to come back to our next webinar on the 29th of April, where we'll be presenting CW's views on the macroeconomic consequences of COVID-19, counting this time with the presence of our managing director and head of research, Robert Madeira. Our webinar presentations are always supported by a brief macroeconomic analysis, but on the next webinar, we will have put together a much more in-depth view of CW's perspective of the current state of the global economy, as well as a careful deconstruction of the real impacts of the world pandemic in the upcoming years. Now, focused on the volume forecast reports. This update of VFR is published at the very beginning of April, and an extensive analysis will be published in September. This extended analysis, of course, includes detailed analysis of cement production, consumption, net trade, and capacity. For the current update, we provide revisions on 2019 estimates, as well as an update on forecasts for the next 5 years. For this particular update, we felt the need to revise our methodology given the unfolding events. This in practical terms means that we worked on the 3 scenarios basis, where we tabulated a much larger data set covering a global, region, and country level analysis of 57 countries. In addition to that, this version of the report also includes our long-term forecast of cement demand for the next 30 years, which is what we are here to discuss today. This map represents the footprint covered by VFR. It's our constant endeavor to increase coverage, but of course this needs and depends on availability and reliability of information. Having a quick and very shortened version of our methodology, this global cement forecast in terms of volumes includes historical annual data on cement production, output capacity, consumption, and net trade. Forecasts are made country by country basis based on past tendencies and macroeconomic data such as GDP and population. Regional forecasts are extrapolated from the cluster of sampled markets. Unlike previous editions, as I've mentioned, This version was done with a bit of a twist in terms of methodology, where we include multiple scenarios given the uncertain times that and challenges that we face today. Thank you so much for your attention. I will now pass the presentation to my colleague Prasham, that will start by providing a macroeconomic analysis of the world during these challenging times and a bit of an unveiling of what's to come next week. Thank you so much. I will see you next week. Now, Prasham.
Hello, everybody, and welcome to CW's webinar. So let's move right along on to the main slides. Next slide, please. So as you can see on this slide, this is just according to IMF data. The IMF is now feels confident that the global economy is headed for a recession, which is expects to be much worse than what was experienced during the 2009 to 10 financial crisis. In fact, all of the G20 economies are now expected to contract or should show reduced growth, at least in the first half of this year. And perhaps more concerning is the fact that the revision of economic prospects for the advanced economies is as startling as the expectation that China may only grow by a little more than 1.5% this year. In fact, the socioeconomic and political impact of the aftermath of this pandemic is going to be felt long after it has subsided. The loss of millions of jobs, and just to put this into context, it was reported also in China that after the closure, 8 million people there had lost their jobs, and that's not including like what has happened in Europe and the United States. So we're not talking about abstract numbers, we're talking in the tens of millions now. And this just emphasizes the fact that things are not going to go to normal once this has been defeated, shall we say. In fact, some epidemiologists have actually said that the coronavirus could possibly resurrect in the winter in conjunction with the flu, and this could possibly carry on in some form until 2021. So the impact across the economy, including construction, is actually still unknown because the damage is still unfolding right before our eyes. Next slide, please. So as we have been doing over the past few webinars, this is a sort of a glimpse as to where we are at the moment. As you're all well aware, the first case of coronavirus was detected in November of 2019. But since then, the US has become the major epicenter with, of course, both coasts being considerably affected, and now it's spreading across Middle America. And the country now has in excess of around 850,000 infections and almost 50,000 deaths. For Italy, Spain, and France, they have also all crossed almost 5 to 6 times the death toll that has the official death toll in China. And the number, unfortunately, of infected people is still growing on a daily basis. So we are not out of the woods yet. Next slide, please. But is that the only thing that has been affecting world markets? Unfortunately, that is not the case. As you can see on the slide, crude has taken a beating, and crude prices have actually, this carnage started in early March when Saudi Arabia and Russia were engaged in a price war. And as a consequence, crude oil prices have dropped precipitously to actually levels only seen twice in the last 70 years. Just a few days ago, we witnessed futures, oil futures of a negative $37, something I don't think anybody ever had thought about or envisaged, but only goes to highlight the gulf between supply, demand, and storage, and is a clear indicator that the oil market, at least currently, does not see a quick recovery in terms of the economy globally at this moment. Next slide, please. So right now, when we look at the Baltic Dry Index, things were very good in the third quarter of last year, and since then it has sort of plummeted. This was the case where in January the index started declining because China was actually starting to close down, or actually had first admitted that it had closed down, and it was spreading across the globe. The WHO declared the coronavirus as a pandemic in late January, and since then, February was a very bad month for the index. Since then, however, it's actually recovered, and primarily the recovery has been because of the increase in traffic on the Brazil to China route, as Chinese buyers are taking advantage of things stabilizing China and using the low sea rates as an opportunity to book cargoes at a cost-effective price. But more pertinent is the question, is this actually trend sustainable? As economic numbers being reported continue to cause ever-growing consternation for economists. In fact, the WHO actually has reported that nearly all regions will suffer double-digit declines in trade, with exports, especially from North America and Asia, to be hardest hit. And it will fall steeper in sectors with complex value chains, such as electronics and automotive products. So the jury still remains whether this bump up is likely to be sustained or not. At least in the short term, as economic data rolls in, which will sort of be much more worse in April than the numbers for March. Next slide, please. So an unfortunate consequence of this lockdown is the fact that to prevent the spread of the pandemic, it has actually resulted in the loss of millions of workers that are employed in airlines, tourism, and manufacturing industries that have either found themselves unemployed or are facing salary cuts or cuts in benefits, or actually both. And the impact of the ability, and this will of course impact the ability of these workers to sort of service rentals, to pay back mortgages, take out new mortgages, obviously, and consequently affect the number of old housing units and the demand for new housing units. Should the pandemic continue for longer than we expect, these unemployment numbers will sort of increase, of course, and these will be much larger than we possibly ever envisaged. I mean, right now, it's probably apt that we are no longer comparing it to the financial crisis. The only apt comparison is the Great Depression, and that's something that we will also sort of talk about more in detail in next week's macroeconomic overview. The problem is that the confidence of existing workers and the financial institutions that provide loans to both the construction sector on one side and the mortgage applicants on the other side are being tested like never before. Next slide, please. So normally there's very few discussions on sort of debt, but I thought that we thought that it would be an important discussion point to at least put this in people's mind, that the debt to GDP ratio is growing, not only in advanced economies but in emerging economies. While for the most part, emerging economies are sort of actually doesn't look so bad. The debt level ratios for the advanced economies are, some would say, of rather concerning nature. For example, the United States and Japan are multiple times of GDP, Now, even within even within this even within this uh, environment, you see the fact that Canada, the United States, and Japan are treated very differently than the debt of, say, Italy. Uh, Now, to put into context of how much money has been actually added to debt, in a matter of weeks, the United States Congress has passed over $750 billion. That's equivalent to the TARP fund that was put into place in 2009 to affect, industrial and banking sector bailouts. That's been wiped out. This sum has actually been sort of 350 billion was wiped out in the last couple of weeks. They refunded it with another 400 billion, and they're saying that they will add more to the fund if necessary. So the numbers that we're talking about are on levels that we have never ever seen. As you see, the debt ratio is as of 2018, and the reason why is that the IMF has actually taken these statistics down from its website as of April, because they say that we cannot accurately project what these debt ratios are going to be, at least in the short term. So they're waiting as the situation sort of develops, and then they will sort of analyze and then project. So the scenario and the um, is going to only get worse. And why is that important for us? It basically is an important indicator of the fiscal space that these governments will have once this pandemic wears over to sort of invest in different programs, and how much risk appetite are investors going to take in such heavily indebted countries. So that's a factor to sort of keep on our mindset. Next slide, please. Next slide. So now let's move right along into sort of the long-term forecast. And as you can see on this slide, what we try to sort of analyze and sort of evaluate when we were doing this exercise for cement consumption in 2020 is the magnitude of the impact of the pandemic. And we sort of looked at double-digit declines in Chinese cement demand, and we also sort of forecasted the same for the US. Given China's current weight in global cement market, this has the expected outcome of negatively affecting overall global consumption numbers. Of course, no region has been spared. The Middle East, in fact, is actually bearing the brunt of the decline in oil prices, and this is likely to result in less revenues to the construction sector, with already projects being discussed, either being delayed, postponed, or in worst cases canceled. And this will all have the net effect of sort of reducing cement demand. In fact, in terms of CW's estimates, we expect a sort of a 9% decline in terms of consumption from 2019. And the global ex-China picture is likely to be almost around 8%. So in fact, at the global level, the confluence of the coronavirus and the crude oil decline has pushed the global economy into really uncharted waters. Now with a global recession a certainty, even if we expect China's demand to turn around miraculously, they will not be able to turn the declining tide of consumption this year. Next slide, please. So what is this over the 2050? What are sort of some of the parameters that would be of interest? So one of those parameters that we sort of considered was the GDP per capita. And what you see on your screens are numbers as of the last update by the OECD in July of 2018. I assume they obviously will update once the situation is stabilized in terms of their long-term forecast. But we don't feel that it would materially change over 30 years. The growth trajectory should sort of mirror, even if there are like short to medium term sort of declines and reversals and corrections. But what is not shown here, and what has been the impact of the coronavirus, is that it's sort of upended global growth prospects in the short to medium term. Latin America, which has had a poor last decade, was actually finally expected to make the turn towards sustainable growth this year, especially Brazil, that was emerging out of a long, long period of economic troubles. Uh, the region as a whole is likely to lose sort of years now before it reverts back to the economic growth levels of 2019. Now, over a longer term, China is expected to emerge as the single largest economy sometime by the next decade, or even maybe even earlier. And it will, though it will see a very impressive increase in per capita growth. Its large population base, however, ensures that the growth per capita will not reach that of advanced economies. And why is that important to us? Well, over the long term, there are many drivers and constraints, and we will share some of them on the next slide, which impact construction, the construction sector and cement demand. One of those, the rising levels of economic growth in emerging economies, will be a critical driver for cement demand. So even as China sort of moves up the economic ladder, its per capita income will likely be remain at levels far less than those of the advanced economies, but that's almost to be expected at this moment. Next slide, please. So as you can see on your screen, there's a multitude of factors, some drivers, and some constraints that impact the overall demand for cement by 2050. And in our perspective, the main drivers are continued economic growth in emerging markets, which is helping to increase the standard of living of hundreds of millions of people. And this phenomenon obviously also leads to increased urbanization, and therefore consequently the need for housing. Which also then therefore translates into most cement demand, because cement is the most readily available and cheapest sort of construction material in the region. In conjunction with economic growth is the fact that there is population growth. And although birth rates in emerging countries are considerably lower than a decade ago, this means that there will be sustained additions to population numbers, which of course, again, require housing and therefore more demand. On the flip side, though, stricter emissions regulations, such as the international agreement like the Paris Agreement, are making emissions a central focus, which leads to pointing of fingers, especially on the cement industry, because of the high levels of emissions that are produced during the production of clinker. And last but not least, a renewed focus on all things green, such as green energy. Green construction is also not far behind, and this trend will also play a role in reducing the demand for cement as new materials are sought. This trend also is actually encouraging already the use of alternatives such as slag and fly ash in cement to reduce the volume of clinker, so as to sort of reduce the emissions. So as you can see, we expect demand growth for cement to actually reach 6 billion tons by 2050, which is when you're looking at the quantum of time period, maybe not big, but it does show that the cement is here to stay. Next slide, please. So in 2050, what does the world look like? So we expect that China and North America and Europe will continue to sort of decline. We expect emerging Asia, led by primarily China, India, and Vietnam, and also Eastern Europe and CIS, led by sort of Turkey, will continue to drive growth for cement. Now, one point that I sort of didn't mention before as a driver constraint is climate change and rising sea levels, which we feel they are an outlier in terms of impact, but they're not considered a black swan event because this topic has actually been discussed and for a long time, but we don't feel that it's actually been considered in the totality of impact from the point of view of increased cement and concrete consumption. So as more data comes in, as rising sea levels, we do expect sort of our perspective to change. And as this is a thought exercise, we will definitely incorporate those changes as we go forth. Next slide, please. So I would just leave you and bring this circle back to a discussion back to today, because 2050 is a long time away and we are all stuck at home right now. And 2020 is what we are all concerned about. And what does 2020 sort of right now show us? Right now, it shows us that the construction industry is in for a whale of a time. The numbers in the US, Italy, Spain are in no ways, and this is just a few snippets, are sort of really, really horrifying. South Africa has actually been stuck in an economic limbo for almost 2 decades now, and if things couldn't possibly get worse before, they've just sort of now expected to go from 1.5% in the construction industry decline to a contraction of now at least 8.7%. So and the GCC, as previously discussed, is sort of dealing with a double sort of 1-2 punch, with oil being a region dependent on oil revenues, and even when it's not, it's diversifying into tourism, which has now also been affected by the pandemic. So they are also dealing with, 1-2-3 punch actually. That even the thing that they would have sort of used to get out of the price war is likely to be impacted for months to come. So those were sort of, I want to now thank you all for sort of bearing up with us, and I'd like to invite you to join us for next week. And please feel free to contact us should you wish to discuss this or any other topic. Have a great day and stay safe, stay home. Bye-bye.